Hello, Vitavia community. It is Helmer. This week is July 19th, 2023, and we've got your mortgage market update for you for the week. And this week I am joined with one of our guests, is Nathan Einkorn. Nathan, thanks for joining us, and please take a minute and tell everybody a little bit about yourself.
Nathan Einkorn, I'm a mortgage broker out of Colorado. I've been in VA since the beginning. Just happy to be here and help out however I can.
Awesome. Well, thank you for joining us. I am just making the slide look pretty over here because I forgot to put it on preview. So let me change that, and then I'll throw this up on the screen for y'all. Let's see, add to stream. There you go. So this week's mortgage market update. Remember, we're here for you guys. If you have questions, we want to answer them for you. If you're here live, do us a favor. Put a hashtag live, be a part of the conversation, ask us any questions, share your thoughts. Again, as specific as you want to get. If you have any questions about the markets, about rates, about your particular purchase or looking for a home, whether refinancing makes sense, debt consolidation refinances, anything like that, we can answer those for you today. If you're watching on the replay, do us a favor, just put hashtag replay in the comments. We do monitor the post. If you have questions, we're glad to come back and answer those for you. Just tag Nathan Einkorn, or you could tag me, Helmer, and we'll be glad to get those answered for you. So keep an eye on that. And then otherwise, let's jump in and kind of go right into rates and where we're at. Remember, this is not an offer to lend. And when we talk about rates, we're talking about averages and generalities. Mortgage rates are unique to your situation, depending on your credit score and your eligibility, your VA eligibility, things like that. So you always want to remember that the best thing to do to make sure you get a great rate is to shop your rate. But we want to kind of give you guys a good idea of where rates are at lately, and that way you know that you're comfortable with what you're being quoted. So right now, what I've seen is that rates have returned to levels that we saw back in early June. We saw rates go up after June 20th, after the last Fed meeting. Markets were expecting the Fed to raise rates a couple more times this year, and that pushed mortgage rates higher. And recently, we've seen that markets liked the inflation data that we got last week, and it showed that inflation is cooling off. And that's why the Fed has been raising rates, and why we've seen mortgage rates go from the low twos into the sevens, was because of the inflation and the Fed having to fight inflation by raising the Fed policy rates. So anyway, VA rates generally now in the mid sixes is a pretty good number. And conventional rates, if you're not using your VA eligibility or you're not able to get a VA loan for some reason, conventional rates are in the high sixes, maybe into the low sevens. Nathan, what about your neck of the woods, or what you're maybe quoting borrowers? Does that sound about right?
Yeah, no, that sounds right on par. FHA as well, kind of right about an eighth of a point, probably higher than most VA with most of our lenders, but just kind of been on that little mildly up and down roller coaster for the last couple of weeks.
Yeah, and we saw rates, really come to the highest a couple weeks ago. It was actually on a Thursday. Rates were, VA rates were in the high sixes, even touching into the sevens. Conventional rates were around 7.25, 7.375, or what we call 7 3/8. So they were quite a bit higher, and they have moved lower. From here, will they go lower? That's the question that everybody always wants to ask, because they say, okay, well, this is great, but is it going to get even better? And the answer is we're not really likely to see anything happen between now and next Wednesday. There's really no economic data. The different Fed members that influence the rate markets, when they go out and speak, they're not allowed to speak for 10 days in front of a Fed meeting. The next Fed meeting is July 26th, next Wednesday. It actually starts on Tuesday, but it concludes on Wednesday, and that's when we get all the Fed action. The policy statement, they'll come out and talk about if they're going to raise the Fed policy rate, which the expectations are they will, and what they think they're going to do in the future. And then at 2:30 p.m. Eastern time, we get a press conference with Fed Chair Jerome Powell, and that always proves to be very interesting. And I'll circle back on that. We'll talk about that in a minute. But we're not likely to see anything between now and next week that's really going to have much of an effect on rates. Mortgage rates likely to be very stagnant, unchanged. they move slightly day to day, but overall, you're not really going to see too much of a move. And we're not likely to see rates drop much from here because when you look at the overall economy, the economy is still doing well, very resilient, and the job market, especially, is still strong. And there's different sectors and different segments where we could point out some weakness, but overall, the job market is still doing very well. And because of that, it's not likely that the Fed is going to have to worry about trying to fight inflation. If we saw a weak labor market, if we saw the economy was cooling off, the Fed would slow down. But the expectation is the Fed is going to raise the Fed funds rate this meeting on July 26th. They'll raise it by 0.25%. When the Fed raises rates next week, that's not going to cause mortgage rates to go up. Mortgage rates have already priced in that change. Traders are usually looking to the future to see what they think is going to happen. And we see that affecting today's mortgage rates. So the concern is Fed members have said, hey, we're going to need to raise rates at least 2 more times this year. And we've got 4 more Fed meetings. We've got July, September, November, and December. So we've got 4 more Fed meetings. And the different Fed members have said that they believe the Fed is going to need to raise rates at this July meeting. We'll see a 0.25% rate increase, and then at least 1 more time by the end of the year. Now, markets think that because we are seeing inflation get into check and we are seeing the economy hold its ground and not necessarily building up any steam, but not losing too much, and the job market's doing okay, they think the Fed is going to actually go ahead and raise rates at this meeting, and then they'll probably pause for the September meeting. And by the time we get to November, markets think that the economy will be slowing down enough that the inflation will be in check and that the Fed will be done raising rates. So markets are betting on a one and done on this. Now, if markets do grow concerned, if they see a lot of economic data that shows strength and they're concerned inflation is going to rise again, and they are concerned that the Fed will in fact raise rates at least 1 more time after this July meeting, then we could see mortgage rates creep higher and they could move back up to where we saw over the last couple of weeks. But right now, that is not the market sentiment, as I like to call it. It's not the momentum. And, we're kind of in a really good spot. So for the next 15 days, rates could improve after next week's meeting. If you are currently under contract and you're not yet locked in on your interest rate, stay close with your mortgage professional. Discuss with them your unique situation. Sometimes even if you think rates may get better, you may need to lock in just to protect, your purchase, and for a multitude of reasons. So you want to talk about your unique situation. But there is a possibility we could see rates get a little bit better after next week's Fed meeting, and it's not too likely that rates get worse after the meeting. So this is one of those ones that for people that have an opportunity, if you're out house hunting, you can at least go out there looking with some assurance that it's not likely that you're going to see rates that are much higher or higher at all than where we're at today. And that's a good feeling if you're out looking. Gives you a little more time to find the right house, one less thing to stress about. But it isn't likely we're going to see rates really move significantly lower from here, not until the economy gets into trouble. And when I say trouble, that means, that consumers aren't spending money, people are losing jobs, talk of recession increasing. If we see more of that happening, then we could see rates get a little bit lower. Otherwise, I think rates are going to be staying in the 6s for a while. So that's my take. Nathan, what about you? What do you think on all this?
No, I agree. And all those are, especially with the people that are shopping right now, the people that are not yet under contract. One of the key factors I always tell everybody as well is when you are still shopping lenders, it's so important that you get quotes on the same day, right? Because of the market movements. I mean, it's been pretty steady, but there's little dips and there's little rises that we've been seeing. And I've come across where clients called me, they spoke to me today, but yesterday they talked to somebody else. And I always want to tell them, well, hey, guess what? Pricing improved today compared to yesterday. So make sure you call the other person you spoke with as well. So you make sure you're comparing apples to apples when you are shopping around, because the quote, another thing that comes up a lot is people are like, oh, well, I got I'm at 6.25%. Well, if you're not under contract, you're probably not at 6.25%. That was just a quote that you got that day from that specific lender based on that day's rates. So it's always,
Nathan, can somebody lock in an interest rate before they find a property while they're out looking?
Yeah, certain lenders are still offering the lock and shop. However, there is a premium to be paid. The one thing I always tell everybody, don't worry about the banks. The banks are going to take care of themselves and they hedge themselves against us. So if the par rate today, par meaning the lowest rate with no cost, is, say 6.5%, You can do the lock and shop and do a 90-day lock, but you're going to be at 6.875, or you're going to be at 6.75%. So you're going to be a little bit higher. You do have the security of that lock, but you do pay a premium. There is nothing free.
Yeah, and it's rare. There's not a lot of lenders that actually offer that, and that's for a reason. There's a lot of risk to that. But so most of the time, would you agree that most people are going to find a property, and then that's when they're going to start to really get into a position where they would lock in an interest rate? Because usually the loan is associated with the property, and that lock is associated with that property.
Correct. Yeah.
Yeah. So, because that's the question that I see come up. And then what happens if somebody is under contract for a property and they've locked an interest rate and the property falls through? Maybe there's inspection issues, or are they able to, are they starting from scratch a lot of times?
Absolutely, all the time. Like you just said, the lock is associated with that property. It's not associated to the borrower. So if the contract falls out, the lock falls out, you'll be relocking at the updated, whatever the current rate is.
Yeah. So, and that's why it's good news, for those of you that may be out looking. It's very unlikely that we see rates move much higher from here, and they could actually get a little bit better. Don't get too excited looking for rates in the 4s or the 5s. It's probably not going to happen for quite a while. If it's an if situation. And what's funny is a year ago, this is why forecasting is forecasting, right? A year ago, it looked like we were talking about, hey, around this time, July of 2023, we think that a recession will be knee deep in a recession. Consumers won't be spending, people will be unfortunately losing jobs. And what that does is that brings rates down. And we figured mortgage rates may be lower, but they're not.
I think my wife's spending is single-handedly keeping the economy afloat right now.
Yeah, I blame my wife, but I spend more than she does. I love Amazon. So I was one of those people that supported Prime Days. Got me a wall-mounted pressure washer and a new Kindle reader. So awesome. Well, what about in your market? With rates being where they're at, a lot of people say, well, maybe I'll wait until rates come down before I look to buy a house. Do you think that's something that people should consider in your market, or even other markets? Or what is your take on that?
Even with where rates are at right now, the rent versus buy scenarios are still in favor of purchasing. I mean, right here in Colorado, a couple of the realtors I work with had recently let out some market stats where, and showing actual properties. If someone had purchased a home in February here in Colorado, we've seen 9% growth in equity, right, in the property values. So if someone bought a $500,000 property in February, right now that house is worth $540 something thousand, right? So by waiting, people are missing out on that, right? And even with where the rates where they are, your rent is, let's say your rent is 28. I mean, out right here in Colorado, rents are getting pretty crazy. Even down in the Springs, even down, in some of the places that used to be less expensive, or places that you could, hey, you couldn't afford Denver, you can check out the Springs. It's not the case anymore. The gap is gone. It's just, home ownership. There's so many benefits to it, and primarily the main thing is you're not paying somebody else's mortgage. You're building equity. Even if you're here for a year, you're more than likely going to come out on top. If you buy here now and then a year from now you have to sell, especially for the people that are still active duty, that are going to have to PCS eventually. It's more than likely going to be more beneficial to purchase, especially with the VA loan, right? The rates where they are, like I said, they're still in the 6s with a point buy down, which is not uncommon in our market now for the realtors to negotiate those buy downs. We're getting VA loans in the 5s. So.
Right. And I should be clear about that. When I said about not seeing those rates, I meant without those points, but when you do have a point, and for those that are watching, when you talk about like a discount point, just tell everybody, what is a discount point?
A discount point is a percentage of the loan amount that you're going to pay the lender in order to get a lower rate. So if the par rate, we use that term par, meaning that's the lowest rate that's available that doesn't have any costs associated with it. Well, you can get 6.5, but if you want to pay 1 point or 1% of the loan amount, so on a $500,000 loan, that's $5,000 that you pay the lender will give you a lower rate. So instead of 6.5, let's say they'll give you 6%. Right. And then it's the mortgage broker's job. And this is what this is how we advise our clients is we look at the break-even analysis, right? How much are you saving between 6.5% and 6%? Okay. Now, how long are you going to be in the home? Okay. Now, if it's $150 a month savings and you're going to be in the home for 2 years, the buy down isn't worth it. They'd say you're not going to recoup that $5,000 cost, right? Unless you have to buy down, right? If you have to buy down to qualify, that's another conversation. But the most important is to make sure that when you are rate shopping, when you're looking at it, if you get one rate from somebody, that's not your lender's not educating you. They're not doing their due diligence. You should get at least 3 or 4 rate quotes. And oftentimes what we do is I'll actually send them a picture of the rate card that shows like, hey, here's all the rates that are available to you. Because right now on my rate card, I can go down as low as I think 5. I haven't looked at it this morning, but I think yesterday 5.125 was available. Now it cost 4.5 points. So on a $500,000 loan, that's $22,000. So it's probably not going to make sense in the long run. But those rates, they're there and they're available. And it just like I said, making sure that you're being given options. And you can see, there's also the other way you can go, right? Having trouble with closing costs. Well, instead of 6.5 with a higher interest rate, as long as you still qualify, let's say, hey, you can afford 6.875. Well, great. If you take that higher rate, the lenders will give you a lender credit. And this is where they're going to, contribute, say, $3,500, $4,500 towards the closing costs on your loan. But it's all percentages based on the loan.
Right. And somebody doesn't always have to do 1%, right? It can be 1% is 1 point, but they could do a 0.5 point. You would give them, as a mortgage broker, you might give them different options and say a 0.5 point, you're going to get this interest rate, a full point, and maybe, and sometimes they're weird numbers like 1.34, and it's going to cost this much money. So that's just for things. And if someone has questions like that, ask them in the Vetted VA Facebook group. That's what your moderators are there. Professionals like Nathan are there to explain it to you without having any kind of a sales pitch to it. And you guys can ask any questions in that Vetted VA group, and your moderators will make sure you're getting vetted answers. And they've all gone through, some really rigorous training and testing to make sure that they're giving you correct information, and you're not just getting something off of a 3-year-old blog that, Chat GPT showed you. So, definitely the forget artificial intelligence, go with the real intelligence. What about, a lot of times people say, well, if house prices are going up, rates are going up, we're in a housing bubble. All these housing prices are going to crash. What do you think, Nathan?
One word, inventory. That's the only, right. We haven't been building enough houses. There are still more borrowers than there are homes available. That alone, really is going to, unless we see kind of the same things that you're talking about that'll lead to, rates coming down, would be unless we see major, huge losses in employment, things along those lines. I just don't see it. We're still seeing houses getting multiple offers. We're still seeing, open houses are getting, 15, 20 visitors a day. I personally, I just don't see it. The inventory is the major contributor. We just have way more people looking for homes than we do have homes available.
So, and anybody that watches this, I'm going to train you on what causes a housing bubble and when we would actually see something that we have to be concerned about. And it has to do with the job market. If you go back with 2008, the reason that we had a housing price crash was because we went into the Great Recession. And as part of that recession, a lot of people lost their jobs. When you see unemployment numbers go high, when people lose their jobs, well, they don't have other options. They can't refinance because they can't show the bank that they have a way to pay back that loan, right? So they have equity in a property, but they have no way to pay their bills. That leads to people making the tough call where they have to sell their home in order to get out of being in a bad financial situation. And that puts more inventory. And that goes back to what Nathan said. So it all has to do with inventory, and the inventory will only increase if people are forced to sell. And right now, people have interest rates that they have gotten over the last few years. They might be in the 2 or 3% interest rate range. And those people are not making moves. They're not buying because, number one, it's extremely more expensive to buy a more expensive home when you're doubling the interest rate. And number two, it just doesn't emotionally, who wants to go from a 3% rate to a 6% rate? So there's a lot of people that are sitting on houses, and maybe, that they had a new kid or they some other life change. And, unlike when someone gets PCSed and they have to move and they have to, deal with making a decision of holding on to real estate and renting it or selling it. And, these decisions have been made for them where they're going to go. Other people are staying where they're at because they'd rather put two kids in the room. They're young. We got two boys. I used to share a room when I was a kid, rather than this idea that everyone's got to have their own bedroom and their own bathroom now as I watch HGTV. So anyway, there's inventory, definitely a thing. We're not in a housing bubble, and we won't see housing prices drop unless we see the labor market crash and we see unemployment skyrocket and people can't afford to pay their bills. That's when we will see home prices come down. Anything other than that, you're not going to see home prices drop.
Yeah, I think my biggest surprise this year is the continued appreciation. I honestly thought that was, I think a lot of us last year speculated like, hey, you know what, we're not going to see this crazy appreciation anymore. We're probably going to drop down to like the historical average, which is like, 3.5% to 4% per year. And, to see the stats that have been coming out from the first two quarters and just see that, we're still seeing, we see 9% appreciation already this year. Yeah,
yep.
It's just,
it's different in different markets. Like you're in Colorado. I'm in Western North Carolina on the East Coast. We're seeing strong sales here. If you go to California, some of the ridiculously overpriced homes, the Bay Area, those kinds of things, they've seen some depreciation, but that's a totally different market. There's a lack of affordable housing. There's no such thing as a starter home anymore. Homes that are in that, depending on where you are in the country, but what's like $250,000 to $450,000 range. That's generally that sweet spot for many of us to at least get in and buy your first home, or and those houses they get bought up very quickly. There's there's a lot of people that are looking for that same price range, whereas it's a very different market for somebody that's looking for maybe a $2 million house. There's less people looking and less people selling, but for that sweet spot, it's very, very busy. It's a very, very busy market. So,
yeah, and for a lot of my agents in California, I've heard there's more of a correction, right? Than there was. Not necessarily that the house prices are coming down, but the housing prices are getting more realistic to because the market sets the price, right? Whatever someone's willing to pay for it, that's how much the house is worth.
Very much so. So, well, everybody, if you have any other questions and we didn't get to answer them for you, make sure you go ahead and just tag us in the comments. We will be glad to come back and answer them for you. Nathan, is there anything you want to leave everybody with?
You said it at the very beginning, and I just can't agree with it more, is that, shop, speak to multiple lenders. In the end, find somebody that you trust, like the motto of Vetted VA, trust but verify. And when you find that person, just work closely with them, stay in contact with them, because they're your partner in trying to get you into that house. And nothing wrong with shopping. It's actually encouraged. But when you find your person, that it's time to move forward.
And then I'm going to share my screen again real quick here. Let me pop this up here. I think most of you are familiar with it, but in case you're not, you can go to vettedva.com. You'll find a map, and you can look for vetted professionals. Again, still shopping around, but you can find different vetted professionals in where you're buying and know that they at least have passed rigorous testing and requirements to for you to even know that they exist, and that they're going to have your best interests at heart. Everybody that's part of that program and is put in for that training. So that's always something that you guys can use.
Yeah, it makes a huge difference. I mean, we see it every single day in the group. Borrowers being told, loans not closing, borrowers being told they can't do this or they can't do that, and a vetted VA professional from their state or from where, is able to step in and let them know, like, hey, no, this actually can get done. There's a lot of, the VA loan is the best loan out there. There is a lot of nuance to it. It's the only loan where there's actually guidelines that direct the underwriters to do everything they can to get it approved. And so, if you've got a good advocate on your side, more likely than not, we're going to get you into that house.
So awesome. Well, thanks again, Nathan, for joining us. Everybody, remember, we do this every week for you. You can join us each week, 12 p.m. Eastern, 11 a.m. Central, 10 a.m. Mountain, 9 a.m. Pacific. If you have any questions that you'd like us to answer, especially about mortgage interest rates, things like that, just tag us in the post, and we'll see you next week. Take care, everybody.